I'm going to teach you one of the most important concepts in all of options trading, the relationship between how stock price changes and implied volatility changes. Once you understand this concept, I'm going to show you how to use it to find some of the best options trades that you're ever going to come across. The kinds of opportunities that only come around a few times a year and that most traders miss. Let's jump into it. So first, let's get some clear definitions. When I'm talking about share price or spot price, I'm just talking about the price of the underlying asset. Let's say we're talking about Tesla stock, it's what price is Tesla trading at right now. Implied volatility, the other term that we need to understand, is how much the market expects the stock to move over a given time frame. Spot IV correlation or spot vol correlation measures how much a change in stock price impacts implied volatility numbers. In some assets, when prices go up, so does implied volatility. In others, when stock prices go down, implied volatility goes up. Different assets behave differently, and understanding the relationship between these two is pretty critical. Let's just start with the S&P 500 as an example. What do you think would happen to implied volatility if the S&P 500 were to go up in price? Well, what would happen is that on average, implied volatility would go down slightly. We would say that there is a negative correlation between share price or spot and implied volatility or vol. If the S&P 500 were to go down all of a sudden, then we would expect implied volatility to increase, once again reflecting that negative correlation. And this is where we get the idea of stocks going up like an escalator and down like an elevator. It's because when stocks are going up, they tend to move up pretty slowly and volatility tends to be low. And then when things are going down, they tend to move down really fast, and then obviously volatility expands and implied volatility increases. And this is what we see for most tickers. There tends to be this negative spot vol correlation because they all kind of behave this way. Volatility should be pretty low to the upside, and if there's going to be a big move in the future, we should expect that it's likely to the downside. The relationship between share price and implied volatility typically embodies this. Now, sometimes, as we saw with GameStop in the past and MSTR recently, sometimes tickers can show a positive spot volatility correlation. A lot of times this happens during memes and bubbles, so think about it. When a company like GameStop starts to rally hard, what happens to volatility? It tends to expand because the risk, the fear that people have, the uncertainty is that GameStop will continue to rally. It's not that it'll go back down. We know it eventually should, but the fear and the risk is that it keeps on going up. And then when GameStop eventually starts to come back down or calm down at least, we see the implied volatility contract. And so it is possible for individual tickers to have a positive spot vol correlation. So understanding this relationship can impact the way that you learn to structure trades. Let's say that GameStop rallies hard and is up at $80 right now. You know that in the future, if you think that options are expensive, you also expect that the share price is going to come down. You think that IV is going to decrease, which also implicitly means you think that the share price will go down a little bit. Now let's talk about a really rare and profitable trade scenario that you can only really identify and take advantage of if you understand this relationship, the spot volatility correlation. During massive bubbles, such as with GameStop and AMC, and most recently with MSTR, tickers that normally have that negative correlation, it flips to be a positive correlation. Identifying opportunities like this, it's usually pretty simple because everyone will be talking about it, but typically you will see a huge surge in share price and a massive increase in implied volatility. What happens next? Well, after that blow off top event that happens, the stock starts to cool off, and even the stock could move down pretty quickly, but at the same time, implied volatility will also start to drop off as the fear of wild future moves starts to decrease. So here's the setup. After you think things have peaked, we can look to go out and sell deep out of the money puts. And here's why it's such an awesome trade. If the stock continues to rally really hard, the puts are going to become worthless. So you're going to make money on that side. And let's say the stock decreases in value. It starts to drop significantly. At the same time that the stock's going down, implied volatility is going to be collapsing. And in some cases, it'll even collapse faster than the decline. Meaning you could end up in a situation where the stock could drop off huge and you still make money because of the IV decrease. Meaning the puts you sold are still going to lose value really fast and you'll actually potentially come out with a profit or break even if you're technically wrong about the direction that the stock went. Remember, in this situation, you're trading the collapse of the volatility, not necessarily the direction. And this is a type of trade that can seriously boost your annualized returns if you time it a little bit correctly. But almost nobody outside of real volatility traders knows about this type of situation. So it all boils down to this. Understand the relationship between spot and vol correlation. That's the basics. You gotta know the fundamentals. But once you understand that, start looking for times where that relationship has flipped from negative to positive. Because in those situations, if it's a bubble, there can be a really good trading opportunity where you can sell deep out of the money puts, which will make money if the stock continues to rally, but also have the potential to make money if the stock calms down, because as the share price decreases, so will the implied volatility, which is a rare situation, but when it does happen, it can create some phenomenal trades. If you like that and you want some more awesome strategies, including 5 systematic ones, click the link in the description. Take a free trial with Predicting Alpha. If not, that's all cool. Make sure to subscribe though. That's the least you owe me for this video. I think it's some good game I put you on, and a subscription helps the algo. So do that and leave a comment if you have any questions. I'm happy to chat about it, and I'll see you in the next video. Happy trading, everyone. Peace out.